up, gold investors? Another swing entry point is here. Don't let today's red candles freak you out. This is just a routine pullback. We are likely to retest the 4,200 level short term. The reason for the drop is simple: early profit taking, rallying over 60.5% in just 6 days from the 3,941 bottom to Monday's 4,200. The upside slope was simply too steep, and a correction was bound to happen anyway. Besides, this rally wasn't driven by slow money like ETFs. It was pure hot money. Speculators pumped the price during thin liquidity last Friday when the US market was closed. That kind of rally lacks solid ground. Fast up, fast down. So, after today's shakeout, why am I still expecting a short-term bounce? First, Thursday's FOMC meeting will likely trigger a sell rumor by the news reaction. The market had been pricing in rate hikes through the non-farm payrolls, just caught the odds of a September hike in half. And still, capital remains skittish. Yet, there's an 80% chance the Fed pauses this Thursday. When that happens, the market will realize aggressive hike fears will completely overblown. And once the dust settles, the hawkish narrative we've been hearing will be completely debunked short term. And on top of that, Trump has been aggressively talking up the markets lately. To keep pace with US equities, the Fed urgently needs to drop some dovish hints to suit the market. And second, while gold pulled back yesterday, SPDR was quietly accumulating. As of yesterday, SPDR holding tick up by 2.7 tons from the previous day. A single day might not mean much, but look at their track record. On July 1st, a tiny gold gain triggered a tentative 0.285 ton buy. On July 2nd, a big rally saw them immediately dump 3.996 tons. We've seen this exact playbook play out several times over the past month. This leaves me highly suspicious that the smart money is just swing trading this choppy gold market. This deep buying by SPDR should suggest that big players anticipates another leg up. They're front running the bounce, positioning themselves to dump at the highs with precision. And this is exactly why I remain mid-term bear. Unless we see massive sustained ADF inflows for weeks, every single rally is just a bounce, not a reversal. And finally, here's a strategy catalyst that most people are sleeping on. Today, the Hong Kong Precious Metal Central Clearance System launches trial run. To sweeten the deal, HKEX announced a 1-year fee waiver on gold futures. This is a massive, tangible catalyst. Zero fees will act as a magnet for global high-frequency traders and arbitrageurs, injecting massive liquidity into the Asian session. But there's a much bigger narrative here. Asian consumers have the words gold, yet we've always been at the mercy of New York and London. And time and again, Asia pumps the price during the day, only for Wall Street to dump it and clear the board all night. Asian capital has essentially been Wall Street exit liquidity for years, and Hong Kong's new clearing infrastructure strikers right at this pain point, pricing power. Granted, reshaping the underlying rules is a slow macroeconomic variable. It won't speak an overnight moonshot, but a tectonic shift in capital channels and market structure has begun. In as little as 3 months, we might start seeing some massive shifts on the charts.
The better the news, the hotter memory chips crash. The tallest poppy gets cut first, and that's exactly what's happening to US stock. Let's be real. US tech right now isn't about fundamentals or macro, it's pure sentiment. Otherwise, why would some drop killer earnings spaz across the board only for the market to absolutely slaughter the hottest memory sector right then and there? Bottom line, big money is using this crowded trade to sell the news and de-risk ahead of earnings season. Why? Okay, here's the deal. The latest Huawei survey shows 80% of global fund managers call long semis the most crowded trade in the world. What does that mean? The ship is simply too full. When is this fact? Even the best earnings become a selling news trigger. So why target memory? And why now? There's a massive catalyst. SKN's ADR formally list in the US this Friday. The playbook is simple. Hynix pricing tax directly to its domestic stock in Korea. The hotter Korean stocks get hammered, the cheaper the US pricing, leaving huge arbitrage room for big institutions post-listing. And since Korean index is tied at the hip with memory, the ultimate bellwether for US tech, it gives institutions a perfect excuse to shake out weekends across the sector. On top of that, funds are aggressively bleeding positions in Micron and in MD just to free up cash for the Hynix IPO. So this crash is not a fundamental breakdown, it's a liquidity squeeze and attack to shake out. What's the next move? Odds are we'll see a bounce right after Hynix list on Friday. And first, the Nasdaq 100 push move forwards passive index funds to buy in. That's a real and fresh liquidity.
And second, cash bark for the IPO will rotate back, rebooting those previously gutted positions. But warning, this bounce is not the start of a major rally. The real midterm direction hinges on big tech's earnings call late July through early August. If there's even a whisper of Kappa's slowdown on those calls, tech stocks at its highs will face a massive stampede. Flip side, even if Kappa speeds, you will get a muted pricing bump at best because anyone buying the story is already in. Anyone on the sidelines won't chase at these levels. So, to sum it up, this sell-off isn't a macro disaster. It's a crowded trade cashing out on good news. Memory was targeted to shake out weekends ahead of Phoenix listing, all driven by institutions front-running the August earnings mindfight field. This short-term dump is a fake out, a cleanup. But if it bounces, remember, that is not your kill to buy the dip. It is your final chance to manage your risk and get out gracefully. Okay, this is just my personal analysis, not financial advice. And also shout out to EBC Financial Group for sponsoring the content.